What is the thought processes behind dynamic volatility, and what's it going to do for them?
As we all have experienced, fixed income markets have garnered much more attention recently, given higher yield levels and potential Fed easing, especially with yesterday's Fed announcement. It looks like, depending on economic numbers in the next couple of months, there will be an initial Fed cut. But regardless of the future series of Fed actions, if they occur, prudent investment management always requires proper risk diversification and risk management. We look at the overall fixed income market based on duration exposure and product type. So from top to bottom, you have different duration instruments, starting with negative duration. MBS interest-only securities are one of the few instruments out there that actually provide negative duration, but current income at the same time. And then as you extend out in duration, you have various product types that are short, intermediate, long, and ultra long. And then across the top, you have different product types ranging from treasuries, corporates, munis, structured products. And so these are the ingredients of our fixed income model that captures the risk and return elements of all these sectors and optimizes the portfolio by targeting the volatility of the Bloomberg Aggregate Index. When you do that optimization, you're maximizing yield and returns. You typically end up with 5 to 10 ETFs. In order to capture the ongoing moves in the capital markets, we actually run the model daily, but rebalancing only occurs whenever the risk threshold deviates by 15%. To summarize, we're generating higher income and total returns than a passive index. We're generating attractive security selection alpha. We have good downside protection, as shown the past few years when we've had one of the highest volatility in the fixed income markets. We were able to generate much better returns. And over the past year to date, we're outperforming the Bloomberg Ag by 400 basis points. We are outperforming the index by anywhere between 300 to 500 basis points over the past 1 to 3 years. And over the long run, it's been 200 to 500 basis points. Given that all the ingredients are ETFs, liquid ETFs, the rebalancing exercise is very straightforward. They're all liquid ETFs that trade actively, and it's a much better way of allocating to the fixed income market than trying to rebalance a portfolio of 1,000 CUSIP bonds.